Welcome to Breaking News to Trading Moves. Today we're looking at a pretty noteworthy financial move. Blackstone making a major investment in India's federal bank. And while, the deal is happening in South Asia, we're seeing effects playing out right here in certain U.S. market segments.
That's really the focus here. It's not just about one bank getting a cash injection. It's more about understanding the adjustments this kind of deal tends to accelerate. Our aim is to map out what this means for U.S.-listed companies. Figure out who might be positioned, the winners, and who might face some new competitive challenges, let's call them the losers, as these Indian financial deals pick up pace.
Okay, let's start with the deal specifics. Blackstone is putting in about $705 million. That gets them a 9.9% stake in federal bank. It's a fair chunk of change.
It is. And that percentage, 9.9, is often chosen carefully. It gives influence, but usually avoids some of the tougher regulatory hurdles that kick in above 10%. Maybe even more important than the exact dollar amount is what comes with it. Blackstone gets a board seat.
A board seat. Okay, so this isn't just money sitting there. It's active involvement.
Exactly. That's the signal. This deal, it really highlights the perceived growth potential in Indian private banking. An investment like this, from a name like Blackstone, it basically tells the rest of the private equity world, okay, the water's fine. Now's the time to deploy serious capital in Indian financials.
How does that capital going into an Indian bank actually translate over here to the U.S. market, though? It feels a bit removed, but I guess the financial system is all linked up.
Oh, it's completely interconnected. We usually see the impact through, let's say, three main channels pretty quickly. First, just getting the deal done means advisory fees for the big Wall Street banks. That's immediate. Second, it can act as a bit of a catalyst, drawing more capital into India-focused index funds and ETFs. And third, maybe most importantly, it shifts the competitive balance in areas like cross-border payments, remittances, and even traditional banking for players already operating in or connected to India.
All right, let's break down who stands to gain. The most obvious group, perhaps, are the large alternative asset managers themselves.
Absolutely. And it's not just self-serving for the firm doing the deal, it's about the mechanism. When a firm like Blackstone, that's BX, pulls off a transaction this size in Indian banking, it sort of proves the model. It opens the door, makes it easier for their peers to justify similar moves.
So it kind of legitimizes that particular market and the scale of what's possible there.
It does. It helps de-risk the sector in the eyes of other large investors. These kinds of deals, and then potentially follow-on investments maybe in related areas within India, they create this validated space. And that gives these firms better ammunition for fundraising for their next, say, India-focused or Asia-focused fund, and crucially, more places to actually put that large-scale capital to work.
So we're talking Blackstone. BX obviously is the one doing this deal, but also potentially their peers benefiting from this validation effect, like KKR and Co., that's KKRR, and maybe Carlyle Group, CG.
Exactly. They can benefit from that momentum. It suggests a broader opportunity, making it easier for all the big players in asset management to raise and deploy capital in that area.
Okay, moving to the second category of winners, the global investment banks. The ones actually making these deals happen.
Yeah, this is where you see a direct hit to the revenue line in a good way. Cross-border private equity deals like this one. Well, they generate a lot of work. Plus, you figure a newly capitalized bank like Federal Bank will likely want to do more down the road, maybe raise more capital, maybe look at M&A. That means more mandates.
Walk us through that. What kind of business are we actually talking about?
It's the whole suite, really. Starts with M&A advisory fees for this initial stake purchase. But then, if Federal Bank wants to grow its lending aggressively, they might need to issue bonds, so that's debt capital markets work. If they decide later to raise more equity, that's equity capital markets fees. And anytime you have a cross-border deal involving India, you've got currency risks, so hedging and treasury services come into play too.
That's a lot of different fee streams. So the likely players here are the big global names we usually see on these kinds of deals: Morgan Stanley, MS, Goldman Sachs, GS, and JP Morgan Chase, JPM.
Correct. Their deal engines tend to get busier when transactions like this set a precedent and potentially encourage more activity.
Okay, so we've got the asset managers and the investment banks. But you mentioned a third group benefiting just from the capital flow itself, the index and ETF suppliers with India exposure.
Yeah, this is about visibility and psychology almost. When a major, well-known U.S. institution like Blackstone makes such a visible bet on Indian banking, it tends to draw attention. And that attention can attract more foreign capital into the Indian market generally.
Why does the visibility matter so much?
It can act as a confidence booster. Maybe large pension funds or sovereign wealth funds were thinking about increasing their India allocation but were hesitant. A deal like this can provide some comfort, signaling that other sophisticated investors see stability and growth. And often, that new money doesn't go into picking individual stocks. It flows through index funds or ETFs for broad exposure.
So it flows into India-focused funds, which pushes up the assets under management, the AUM, for the companies providing those funds.
Exactly. More AUM generally means more fee revenue for the fund providers, and it also boosts revenue for the companies that create and license the underlying indexes those funds track. It's a positive feedback loop for them.
So in that space, key names would be someone like BlackRock, BLK, a huge ETF provider, and MSCI Inc., MSCI, which creates many of the global indexes these funds use.
That's right. The more capital flows towards India based on this kind of positive signaling, the better it is for their AUM and index licensing businesses. This Blackstone deal adds to that positive sentiment.
Okay, we've outlined who might gain here. Now let's flip it. Who could feel some competitive pressure from this? You mentioned the incumbent banks in India that trade here as ADRs, the India Bank ADR peers.
Right, this is probably the most direct competitive impact. Just quickly, ADRs, American Depository Receipts, are basically shares of foreign companies that trade on U.S. exchanges. So these are the direct competitors investors here can easily track.
So when one competitor, Federal Bank, suddenly gets this big capital injection and backing, it changes the dynamic for its rivals.
It really does. Think about it. A bank now backed by private equity capital with a Blackstone representative potentially on the board. They likely have a mandate to grow, maybe aggressively pursue market share. They might invest heavily in tech, maybe even accept thinner margins for a while to attract deposits or make more loans quickly.
That sounds like it puts pressure on the established players. They might have to spend more to keep customers or compete harder on loan rates, potentially squeezing their own margins.
Correct. Private equity backing often comes with an expectation of faster growth than, say, a traditional publicly listed bank might pursue quarter to quarter. That speed can force the incumbents to react, maybe spend more than they planned. So we'd be looking at competitors like HDFC Bank, that's HDB, and ICICI Bank, IBN. They now have a rival that's arguably better capitalized and potentially more aggressive.
Okay, second category, facing potential headwinds. Companies focused on remittance and cross-border transfers. The platforms moving money into India.
Yeah, this is about potentially cutting out the middleman. If Indian banks like Federal Bank use this capital to seriously upgrade their own tech platforms and maybe their pricing for international transfers, they could make their own direct bank-to-bank transfer systems much more appealing.
Why does that hurt the remittance guys?
Because remittance platforms make money on the fees or the currency spread, that's their take rate. If Federal Bank or others following suit can offer a direct, perhaps faster, maybe cheaper way for people to send money straight into bank accounts in India, well, that puts pressure on the take rates the traditional platforms can charge.
So the banks could use their new tech capabilities to compete directly, possibly at a lower cost.
That's the potential threat. Banks want to own the whole customer relationship. If they can offer cross-border transfers more cheaply or conveniently than a separate platform, they strengthen that relationship and potentially take that business. This dynamic could affect established players like Western Union, WU, or even newer digital ones like Remitly Global, RELY. Their business model faces pressure from improving bank direct options.
Lastly, you mentioned U.S. fintechs looking at India partnerships. It seems counterintuitive if there's more capital and activity. Wouldn't that make partnerships easier?
You'd think so, but it can actually create a couple of challenges. First, valuations can go up. After a big visible deal like Blackstone's, any decent local fintech or potential partner in India suddenly looks more valuable. So if a U.S. fintech, maybe like PayPal, was looking to acquire or partner deeply with a local player, the price tag might just have increased.
So the cost of entry goes up because everyone sees the potential and local targets become more expensive.
Exactly. And the second factor is increased regulatory attention. When you have large deals like this happening, regulators tend to take a closer look at the whole sector to make sure everything's stable and compliant. This could mean longer approval times for partnerships or new product launches, and potentially higher compliance costs.
Which means it might cost more and, importantly, take longer for U.S. firms to get their products into the Indian market. Kind of slows things down a bit.
It can raise the bar for entry, yeah. This could affect companies like PayPal, PYPL with its global plans, or maybe Block Inc., SQ, as they evaluate expanding into markets like India. They might face higher upfront costs and a more complex regulatory path than before.
So looking at all this, it's pretty clear the Blackstone deal isn't just a localized event.
Right.
It really shows how deploying capital in one specific area, like Indian banking, can adjust the competitive dynamics for banks, platforms, and asset managers operating globally.
And maybe the broader thought for you, the listener, is about the speed of adaptation. When a competitor gets strong backing, especially from private equity focused on growth, how quickly can they really force changes in pricing or technology adoption in these high-demand emerging markets? Watching that timeline, how fast the market adapts, that's going to be key.
This is not financial advice or a recommendation to buy or sell any security. This discussion is purely the opinion of the author of the material reviewed.